There's a noticeable effect on the financial market when interest rates go up or down. Do you notice how traders are so particular and updated about the Fed meetings where they are going to announce the changes in interest rates? Do you want to know why stock traders do this? Then watch this video till the end. Hey guys, welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge for a wealthy lifestyle. To make your investments grow, you need to know how major factors affect your portfolio. Learn how you can take a position in the short-term direction according to the changes in interest rates. So, in today's episode, we're going to learn how interest rates affect the stock market. Before moving on, subscribe to the channel and smash that like button. Now, without wasting much time, let's get started. In any economy, there are various interest rates, and they vary by institution. The most important interest rate, however, is set by central banks and impacts all others. There are two rates in the United States. First is the federal funds rates, and the other one is federal discount rates. The first refers to the interest rate at which one bank loans to another bank, while the second refers to the interest rate at which all the banks lend to the Federal Reserve. When these are increased or decreased, the cost of borrowing charged by banks to businesses, households, and consumers rises or falls. This has an impact on how much money people have available to spend in the economy. The US Fed hiked interest rates by 0.25 percentage points in 2022, from 0.5% to 0.75%. As a result, changes in the bank rate directly affected some of the other interest rates imposed by commercial banks, like the prime rates is the interest rate that banks charge their best customers who have an excellent repayment record. Credit rate, the interest rate charged to hazardous consumers with fair or poor credit who wish to borrow money. Mortgage rate, the interest rate charged on a mortgage over a certain term. The effect of increase in interest rates. When inflation goes up or asset bubbles burst, the Fed hikes interest rates to cool things down. Higher interest rates have an impact on the overall economy. Mortgages, vehicle loans, and company loans become more expensive, causing cash flow to decrease. This can force enterprises to change or halt their expansion plans. Higher interest rates can incentivize investors to sell assets and collect profits in the stock market, especially when there have been a few years of double-digit percentage returns on stocks. As you might expect, such investor actions can depress stock prices, at least individually, if not across significant market sectors. Furthermore, if interest rates climb sufficiently, boring saving vehicles such as high-yield savings accounts or certificates of deposit may become more appealing to some conservative investors. When interest rates rise, what happens? When the Federal Reserve raises the discount rate, financial firms' short-term borrowing rates rise instantly. This has a cumulative effect on almost all other borrowing costs for businesses and individuals in the economy. As it costs banks and financial institutions more to borrow money, these same organizations frequently raise the interest rates they charge their consumers. Individual consumers are thus harmed by rises in credit card and mortgage interest rates, particularly if these loans include a variable interest rate. When the interest rate on credit cards and mortgage rises, the quantity of money available to consumers falls. Consumers must still pay their bills. When such bills rise in price, households have less discretionary money. Businesses' sales and earnings fall when consumers have less discretionary spending money. As you can see, as interest rates rise, businesses face not only greater borrowing costs, but also the negative repercussions of dwindling consumer demand. Earnings and stock prices can be affected by both of these factors. When interest rates go up, do stock markets come down? Here's what happens when the stock market and interest rate hikes in the United States. If you look for data that shows a connection between rising interest rates and falling stock markets, you would be disappointed. Dow Jones Index data has studied the 5 most recent rate hike cycles to discover what history has to say about stock market performance during these periods. Their data shows that the 3 top stock market indexes dropped only once during these 5 long-term hike periods. When all 5 cycles were considered, the S&P 500 delivered a median rise of 30%, the Nasdaq also showed a median gain of around 27%, and the Dow Jones Industrial Average delivered a median gain of 17.4%. For example, in the period of June 29, 2004 to September 17, 2007, the federal funds rate went from 1% to 5.25%, while the DJIA gained 28.7%. We don't need to go back that far to discover evidence that deny the theory that higher interest rates result in decreasing stock prices. The Fed hiked interest rates 3 times in 2017, but the S&P 500 gained more than 18% in that time period. Higher interest rates short-term impact impact on stocks. Is this picture likely to change in the near future? Do investors flee soon after the Fed delivers its statement, but then things improve over time? We've all watched dramatic correspondence over scratchy phone lines announce Fed meetings results as market numbers plummet. A study of the S&P 500's performance during the consecutive 9 interest rate hikes between December 2015 and December 2018 reveals a confusing observation. The S&P 500 fell 0.5% the next day after the Fed announced a rate hike on December 13, 2017, but gained 4.6% after 1 month. In contrast, the rate hike on September 26, 2018 saw the benchmark index climb slightly the next day, but fell 8.5% after 1 month. Unlike the long-term picture presented above, short-term market movements following Fed rate hikes produce a mixed bag of effects. That's cold comfort for day traders. However, for long-term stock market investors, the message is clear. Fed rate hikes aren't necessarily a bad thing. What happens if interest rates drop? When the economy slows, the Federal Reserve lowers the federal funds rate in order to encourage financial activity. A Federal Reserve interest rate cut has the opposite impact of a rate rise. Lower interest rates are seen as an economic stimulus by both investors and economists, as well as a boost to personal and business borrowing. As a result, earnings rise and the economy expands. Consumers will spend more because reduced borrowing rates give them the impression that they can finally afford the things that they want. Send their children to a private school. Businesses will benefit from lower interest rates on operations, acquisitions, and expansions, improving their future earnings potential. This results in increased stock prices. Dividend-paying sections, such as real estate investment trusts, benefit the most from lower federal funds rates. Furthermore, major corporations with consistent cash flows and strong balance sheets benefit from lower-cost debt financing. The bond market and interest rates. Bond prices and the return on certificates of deposit, treasury bonds, and treasury bills are similarly affected by interest rates. Interest rates and bond prices are inversely related to each other. When interest rates climb, bond prices fall. The longer the maturity period of the bond, the more it moves in response to interest rate changes. When the Fed raises the federal funds rate, newly issued government assets such as treasury bills and bonds are frequently seen as the most secure investments. They're frequently accompanied by an increase in interest rates. In other words, when the risk-free rate of return rises, these investments become more appealing. As the risk-free rate rises, so does the total return required for equity investing. As a result, if the needed risk premium falls but the prospective return remains constant, investors may believe equities have become too risky and will invest elsewhere. Bond sales are one way for governments and businesses to raise funds. The rise in interest rates results in a rise in cost of borrowing, resulting in higher yielding debt issuances. At the same time, market demand for current, lower coupon bonds will diminish, leading their prices to fall and yields to rise. In contrast, as interest rates decline, entities find it simpler to borrow money, resulting in lower yielding debt issuances. At the same time, market demand for existing higher coupon bonds will rise, leading their prices to climb and yields to decline. In this type of climate, callable bond issuers may choose to refinance and lock in the current lower rates. A fall in the federal funds rate means fewer opportunities to earn money through interest for income-oriented investors. Newly issued treasuries and annuities will pay less. Investors will shift money from the bond market to the equities sector. As interest rates fall, the flood of new capital drives up the equity market. The influence of expectations. Nothing needs to happen to consumers or businesses for the stock market to respond to interest rate increases. Rising or declining interest rates can also have an effect on investor psychology. When the Federal Reserve announces a rate increase, both firms and individuals will reduce their expenditures. Earnings and stock values will decline as a result, and the market may collapse in expectation. When the Federal Reserve announces a rate drop, the idea is that consumers and businesses would increase spending and investment. Stock prices can jump as a result of this. These generic, customary reactions may not apply if expectations differ greatly from the Federal Reserve's actions. Assume the Federal Reserve is projected to decrease interest rates in the next meeting by 50 basis points, but instead announces a 25 basis point cut. Because the assumption of a 50 basis point drop had already been priced into the market, the news may actually cause stocks to fall. What is the best investment in times of rising interest rates? Because all macroeconomic scenarios are unique, there's no single optimal investment that's appropriate for all investing conditions. Having said that, some investment types do perform better when interest rates rise. Because there is more danger in locking in long-term rates, shorter-term bonds are frequently preferable. If rising rates are being driven by inflation, you may want to examine inflation-targeted government bonds. Finally, if you believe that rising interest rates will have a negative influence on equities, you may want to consider shorting the stock market market, please consult your financial advisor for specific investment advice. That's it for the video, guys. Hope this video provided great info. Press that like button if it did. Comment down on what's the impact of interest rates on your personal finances or investments. Share the content to spread the good info. Subscribe to Ring of Knowledge for more amazing and helpful finance content that will put you ahead of the world. Peace out.